Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us remotely is Michael McKerr. He's a Senior Strategist with Institutional Trading Education over at TD Ameritrade. We're going to take a look at volatility, macro, and some historical precedents. Mike, it's great to have you with us as always. Thanks so much for joining us.
Good to be here.
All right. Now, high volatility presents challenges, also presents opportunities. What have you been telling advisors in situations where they or their clients are looking to use the options market during this time? And we can also take a look at our first chart here with the S&P showing the VIX curve to really see what this volatility looks like.
Yeah, so volatility really has been the name of the game for the last month or so. And over the last month, really since February 24th, when this whole COVID-19 market turmoil really began, the volatility curve has been inverted. And what that means is that the front month volatility, or volatility 1 month out, the VIX, is significantly elevated relative to its 3-month counterpart. Now, what this is called is backwardation. And normally it's the opposite. Front month volatility is lower than the deferred volatility metric. So this really shows that there has been a powerful scramble, at least for in the near term, for options protection against stocks and portfolios. And oftentimes in the past, when the volatility curve inverted, it really marked moments of capitulation, at least in the near term, that often produced a rally of some sort, at least on a multi-week time frame. Now, if the volatility curve, which is still inverted, can actually exit that inversion, it's typically a sign that a bottoming process is really afoot. So that's one thing that we've really been watching closely as sort of a near-term all-clear signal. But really, the VIX is still at about 46 to 48. So that's really telling us that two-way volatility is here to stay, at least for a while, and that we should really expect, based on how the VIX is calculated, around a 3% up or down daily move in the S&P 500.
All right, Mike, let's take a look at the future of equities and the economy, because we've seen central banks like the Federal Reserve make dramatic changes in their monetary policy, as well as governments implementing extreme fiscal measures. I know they were saying, over the last week or two, when our fiscal stimulus was passed, that they're shooting a bazooka into the economy. What does that mean for equities if they're going to continue to inject liquidity into the system?
Right. So I do think that global central banks and sovereign governments are really doing everything that they can to ensure that the lending or credit markets function as smoothly as possible. Their policies and programs really aren't designed for equity markets, so to speak, despite many people really thinking that. They've announced a lot of different QE programs. They've resurrected prior lending facilities that they used in 2008. And they've also created some new ones to reflect the unique challenges that we're seeing today, especially on the small business front, which really is the most adversely affected. So what it really means for the future of equities in the economy, I think at the very least, it should help soften the blow of the current crisis or stop the hemorrhaging, so to speak. Both sides of the aisle here, at least in the United States and abroad, I do think realize this really isn't a matter of bailing out corporations. It's really a matter of ensuring the survival of American business, considering that we really have a joint enemy, so to speak, in this crisis. Now, the economic cost of the crisis, I think, is largely incalculable so far. And I think what you've seen across Wall Street with a lot of the estimates for the second quarter growth here is that there's very wide ranges with those. So not much clarity is known at this point. But I think the way that we're approaching this might be too myopic or might be too nearsighted. What I mean by that is we do need to have faith that this crisis will eventually kind of be conquered, and we're certainly going to see a couple of economic scars in the process, but we're not discussing the potential tailwind from such accommodative policies from not only the global central banks, primarily the Fed, but also the sovereign government. You're certainly going to see the cost of credit remain very low for a much longer amount of time, and governments are really going to continue to support their domestic economies with the full weight of their sovereign laws. So if we do believe that the actions they're taking now are going to push off the worst that we could have seen without it, what are those actions that they're taking going to mean for future economic activity when this health crisis has subsided? What I mean by that is I think the tailwind potential from these policies is going to be incredible when you look out in the longer term from this.
So really, duration is what the outlier is. So let's look at our last couple of charts here. The containment measures from this health crisis have led to, as you had mentioned before, an unprecedented halt in economic activity. So let's look at these charts. Are there any historical precedents from a technical perspective that investors can look at for gauging how long volatility might stick around?
I do think so. And while there's really no direct scenario we can point to from a fundamental perspective that looks like today, I don't think we've ever seen a health crisis to this extent. I do believe that investors' emotion has been palpably felt throughout history in specific price patterns in the overall market. So there's a few things that I really like to track when kind of gauging that sentiment among the investors as a whole perspective. So the one chart that I've got here going back to 2015, this really shows the last 5 years of the S&P, but that indicator that we're looking at is selling pressure. Since the market turmoil kicked off on February 24th, we've seen 10 days out of that 30-day time period where we had 90% plus down volume on the New York Stock Exchange. Whenever you get a 90% down volume day, that's called a major distribution day. And this really represents immense selling across all sectors of the overall market. And oftentimes, these are considered precursors to potential capitulation, at least in the near term, and ultimately are associated with some sort of bottoming process. Throughout the 2008 financial crisis and the European debt crisis in 2011, we actually only saw 6 in a 30-day time frame. So the amount of volatility and selling that we've seen in today's time really is unprecedented. Now, there is another chart that I also like to look at, because while the near-term technicals on the S&P and across the other indices do look constructive, so they do look healthy in the near term, kind of after we saw that potential capitulation on the 23rd, based on what I mentioned before with the selling, I do think that market breadth, which is the gauge of market health on the intermediate time frame, is really showing that the market is sort of swimming against the ocean's current. What I mean by that is there's going to be some headwinds as we do continue to recover from a global risk standpoint. So right now, about 85 to 88% of the S&P 500 is actually still trading below its 200-day moving average. So that just shows there's still such incredible intermediate pressure across the overall equity space. So while these near-term rallies certainly do inspire a little bit of confidence, you have to take it into a much larger perspective, at least on the longer-term charts, and see that it's going to take a while for the freight train to sort of turn around. And I think that elevated VIX continues to tell you that two-way volatility might be here to stay.
All right, Mike, great insight. Thanks so much for joining us.
My pleasure, Jill.
All right, and thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.